Ciao guys and welcome back to Lorenzo to Sense podcast. So today we speak about Oddity, what a disaster that happened. So they report earnings this week and they announced what triggered a 40-50% plus of drop in the share price over a couple of days. So really a disaster. First of all, this is not financial advice. As always, do your own research and due diligence. And let's get right into it. So, Oddity fell off a cliff in Q4. They announced the record 2025 results, revenue up 25% to 810 million with strong profitability. But they warned of a sharp disruption in AD costs from an algorithm change at their largest advertising partner that we all think being Meta. And these caused unprofitably high customer acquisition cost, leading to an expected 30% revenue drop in the first quarter of this year. This is what they guided. No full year guidance, and the stock, as I said, plummeted more than 50%. So they don't even know how to fix it. This is basically what they said. And of course, permabears couldn't have asked for a better opportunity, and the narrative that Oddity is a scam came back stronger than ever. But let's get right into this. So, at the current price, the company is a bargain, unless you think it's going out of business. So, what are, in my view, the only two valid arguments supporting the out of business thesis? The first one is that investors have now lost trust in the management, which isn't telling the truth about what happened, and is probably hiding something even worse than what they have shared. The second point is the company can't return to its previous growth of 20 plus percent per year, and will actually lose market share as revenue continues to fall. Now, on the first point, loss of trust, my thoughts are pretty simple here. I cannot see what could be worse than this. Oran, the CEO, presented the worst possible situation, saying they don't even know how to fix it yet. So what could be worse than this? He could have sugar coated it, claiming they have clear recovery plan and will return to growth quickly and blah blah blah. But I believe it's clear to everyone that they were transparent. They said we don't know how to fix it. We are trying. We are pretty sure we will eventually fix it, but we don't know how long it will take and if what we are doing will be effective or not. No. So I don't see this first argument as valid at all. Now, actually, if I have to think about it, they have always been pretty, I would not say obscure, but they do not share too much about their business, especially on the quantitative side. They do not share KPIs. They are pretty conservative. So I see this opening of Oran saying we don't know what to do. It's even an improvement from what they've done so far. Okay, now to the second issue, to the second point. Let's first, so will they go out of business? Let's first go a bit deeper into what happened. So the issue, and this is a bit, let's say, they have shared enough about this problem. Then we as a community, I've read some people on X that looks to be expert of how this advertising work on Meta. So we tried to rebuild a bit what happened more in depth, and the issue they faced looks coming from the try before you buy advertising that they do, that is even at least up to now, they're strong. No? So try before you buy. It's a model that they used for Il Maquillage and Spoiled Child, and even probably, I'm not sure about, for the new brand, Methodic, that lets customer pay only shipping upfront for a trial, then keep pay on or return the product. So they basically can try for free. And this model boosts conversions and reduce buyer risk. It mimics the in-store trying. No? You go to the store and you try it. If you like it, then you buy it. So they try to mimic the same experience, but selling online. No? This is one of Audity's strengths. Has always been like that. And so this is driving strong growth and high repeat sales. 70% of revenue, of total revenue, is from repeat sales, meaning people that keep buying. And however, is that it has an inherently higher return rate compared to standard e-commerce beauty purchases. That, of course, is positive, but the company's largest advertising partner, that we widely interpreted as being Meta, you can find a lot of Oddity advertisement on Instagram, for instance, recently updated its algorithm. The new algo began interpreting the try before you buy related signal, especially the elevated returns, negatively. So it viewed these as lower quality or riskier signals, higher post-purchase dissatisfaction indicators. So basically, they have some indicator that most likely, if the return is so high, it means that the advertisement is like spam or clickbait or something like that. No, so they flag this as a red flag. I mean, talking about the Meta algorithm. So this diverted Oddity AD campaign into lower quality actions with abnormally inflated costs. So basically, they sent this advertisement to lower quality people at higher cost. So double downside, let's say. The result, sharp spike in new user acquisition cost, making first order profitability unsustainable at scale. So they basically, Oddity was paying 100 the acquisition of a customer that with the first product will pay Oddity 50, just to make an example, right? While they usually are profitable already on the first sales. So Oddity described this as an unprecedented dislocation and an edge case because try before you buy is rare in beauty. Most competitors avoid it due to complexity, to logistics, and so on. And they first noticed this issue in the H2. I believe they mentioned something like this, even though it was not this red flag when they reported. When was it? November, I believe. But it worsened sharply into early this year. Okay, so they believe it's fixable without getting rid of the try before you buy. That is, as I said, one of their strengths. So through adjustments like infrastructure tweaks, better signal optimization, or platform workarounds, and expects meaningful progress in the Q2 and normalization in the second half of the year. This is what they said during the earnings call, right? So they didn't abandon the model, viewing it as a core pro-consumer differentiator. So in short, summarizing, the algo change penalize their return try before you buy setup. That leads to explosion of customer acquisition cost. That leads to them scaling back from AD spend, advertisement spend, because they don't want to be unprofitable. That led to 30% of Q1 drop of Q1 revenue expected. This is what happened. So now get back to my second point. So will the company go out of business? Will they return to growth? The question is, how long will it take the company to return to growth? And will 20% plus growth, that is always what they have guided for and they have beaten always, every quarter be restored or lost forever? These are the questions that we should look for an answer. So nobody knows, of course, but here is my speculation. I believe 2026 is a lost year, so likely ending with 0% revenue growth or slightly negative year over year, right? So minus 30% in the first quarter, and then it normalized to maybe minus 15% second quarter, then plus something third quarter, and plus something fourth quarter. That more or less we end up the year flat over 2024. Then, so in 2027, we restart Oddity will restart growth. Now, the worst case scenario is that they'll need to ditch the try before you buy advertising, which means that most likely they will have higher cost of acquisition for customers, meaning they grow less or they grow the same but are less profitable. This is the worst case scenario that I see, honestly. And yeah, so but I'm pretty confident that there will some growth, positive growth in 2027, because it could not be different. I mean, how this one-time event can put the company out of business? They prove to be fragile, no doubt about it. But I don't think it's like that kind of so severe event, this, even though it's severe. Now, so my takeaway is that Oddity is really fragile, proved to be really fragile right now. It depends on Meta for survival, which isn't sustainable long term. I'd argue that this even will end up making them stronger, forcing them to diversify advertisement partner and channels. In the long term, this even could be even considered positive, because imagine if this would have happened in 2 years or 3 years when they were even bigger and with more brands. So better now, so that they can change, make the strategy stronger, expand to more channels, and grow stronger with a stronger base and foundation from there. So all in all, what happened helped me better understanding how hard it is to build a direct to consumer business, and the level of moat that D2C companies like Oddity, but to mention other LMND, Duolingo, and Hims have built by reaching scale and profitability. Differently from common businesses that rely on external partner for distribution. Think about LMND with agencies. Think about, Duolingo is a D2C, or even Hims, right? All these have reached scale now, and it's highly unlikely that a new entrant will catch up with them. So they are basically racing against incumbents, not against new entrants, right? So this also highlights how social network companies like Meta, which is part of my portfolio, act as a formidable gatekeepers, effectively collecting a commission on revenue from any company selling to consumers. So any company that is selling to consumers, either directly or through partners for distribution, needs to advertise on social networks, and especially on Meta, that account, I believe, for like 1 billion or even more of users worldwide. All right, so this is basically every company is paying a tax to Meta. It's really strong. My thesis, if the company doesn't go out of business, which I don't think it will, my thesis is that unchanged. So it will likely take a bit longer to materialize. So the early signals for the newly launched brand, Methodic, the telehealth brand, are encouraging, as shared by the management, and these are backed up by Trustpilot and App Store reviews, respectively 4.6 and 4.2 out of 5, with already 101 reviews on the former on Trustpilot. So you would expect that at the beginning, maybe you need to fix something on the model or even on the app or whatever, and you get not so good reviews. They are already top of the industry in terms of ranking for the reviews. Okay. So Aura mentioned that they have expanded their capabilities in peptides. So I'm quoting here, Aura, we recently expanded our capabilities into peptides to add to our small molecule foundations and are working on peptide solutions in areas like acne and aging. This expansion into peptides gives us flexibility to identify the right modality to address an individual biological target. So they are moving ahead according to the plan. They are launching more molecule and they are using consumers' data to develop something personalized and different than competition. This is what I want to see. This is the base of all the thesis. And at the same time, they are working in parallel to improve topical delivery of different activities, of different actives to ensure they reach the relevant areas in the skin and maximize the biological effect. So they expect to have 8 products in the market in 2026 made with Oddity Labs, finally, including molecules that cover key categories like acne, eczema, and hyperpigmentation. And they said, and more to come in the future that we are bullish about. So all in all, the thesis is intact. We just had this obstacle in the middle, no? So let's see if they are able to overcome it. Now, to the title of this article, the smartest trade of all time. And guys, let me just remark, this is not financial advice. It's just an input, an idea. So looking at the web traffic of ilmakiage.com, the website of the brand that accounts for 70% of revenue, so it's a good proxy, we can see a sharp decline starting in December. Let me show you this. So as you see here, you can see that starting, this is the organic traffic, the blue line, starting in December, you see a sharp decline here, downtrend, right? So this comes exactly at the moment when they started to having this issue. So it looks like the web traffic is a good predictor, was a good predictor in hindsight of what happened. And most likely it will be a good predictor of when the situation will normalize, right? So it's about 30% less of what it was, the traffic in like October. So it's meaningful, the drop, right? And so the web traffic is a proxy for revenue, in this case even more, and it likely lags the performance of advertising by a few days or weeks as it relates to organic traffic. And I don't think, I'm not an expert here, but I don't think it accounts for meta advertisement direct traffic, right? So it's a lagging indicator because you have the consumers that click on advertise and then advertisement, and then the traffic increase, and then even the organic traffic increase because you have more traffic. So these people once clicked, then they go back again and again to the website once they have known what Il Maquillage is about, right? So it's indirectly increasing even the organic traffic. So you will, I think we will see it when they will have restored and normalized the situation with the advertisement. We will see this appearing maybe 1 or 2 weeks later in the organic web traffic that I can monitor. I don't know, maybe someone has tools even to monitor for sure from, I believe, from the Meta platform, whatever it is. I don't have it, but and I think we will see this before the management will announce the normalization of the situation, because they will take some time. Even once it is normalized, they will take some time to be sure, to make sure that this is stable. No, they will not say one day after it's all positive, it's done, we are out of the mess. So we probably will be able to see this happening sooner than investor will start rebuying and the price will go up. And since the company is basically trading at a ridiculous share price now, any outcome other than bankruptcy will reprice it meaningfully higher. And being able to anticipate management's announcement even by one day means we have a meaningful advantage. Okay? Again, do your own research. As always, deep dive to date performance, quite bad, minus 72%, of course. It was the minus 72% that we got in 2 weeks from when this happened. Yeah, and that's it, guys. So I wish this was helpful, and until next time, ciao.